Welcome to the Keiser Report. I'm Max Keiser. Do you live in the real world? The one with the inflation, declining wages, rising unemployment? Then you're probably the sucker at the Gulag Casino poker table. Because unless you're living in the high-frequency trading, dark market-dwelling, fictitious, capital-wielding, financialized world, you're never going to be able to afford the real world. And unless you can think like fictional worlds where there is no gravity, where up is good and good is down, you'll never be able to compete with those who would steal your real wealth using spoof trades, bogus securities, and fictitious capital. Stacy.
Max, in the real world, no price matters more to the real person than the price of oil, of course. They care a lot about how much they're paying to fill up their fuel tank. Well, it's set in the fictional world where those who operate with fictitious capital set the prices. Shell and BP unmoved by price-fixing probe. Shell and BP shares were trading flat as markets weighed up the implications of an investigation by European regulators into whether the companies may have manipulated the price of oil for more than a decade.
Oh, another one of these price-fixing scandals in the oil market?
Yes, well, we've talked about this before. It's a benchmark rate, so it's set voluntarily by participants in this market, by some bankers. It's not set on the free market. So it's set by some guys like LIBOR, like the ISDAfix, like the gold fix. They call each other up on the phone and say what the price is.
Right, so it's a benchmark price that the industry sets for itself. And since they know what they're going to do, they trade around that. It's trading on inside information using unlimited sources of capital, which is charged at virtually 0% interest rates, making ungodly sums of money with zero risk until such time as they blow something up, and then they get bailed out by the state, whatever state that happens to be. So you've got LIBOR, you've got the credit default swap index benchmark, you've got the oil market benchmark. So all these benchmarks, all the industry benchmarks are being manipulated. They're set and manipulated by the players themselves to aggrandize the players themselves.
So these are called price reporting agencies, PRAs, and in particular they're looking at Platts. And there's this benchmark, not only is it used to set the price of oil, but it's also used to set the price on contracts in the $2.2 trillion base chemical industry, in coal, shipping rates. So it spreads throughout. And little tiny movements in the prices, of course, over a $2.2 trillion industry can mean a lot. And in terms of the real world versus this fictional world, of course, is most voters, because it only comes out during election season, most voters think it's Saudi sheikhs who and the royal families who are setting the price of oil. As these articles note, it's been Platts and the other PRAs since the 1980s, when the Saudis, OPEC, no longer set the price of oil. It's these guys who report voluntarily what they think the price is.
Right, of course, oil is the most heavily traded commodity in the world, and then you have all the derivatives of oil, including the petrochemical business, the plastics industry, pharmaceuticals, et cetera, that all key into the same price. So along with LIBOR, which is the price of money itself, if you've got price of money and oil, and you're fixing those two basic components of the global economy, you're fixing the entire global economy. Add the credit default swaps, which is insurance against trading on all these fixed markets. Add then also price fixing on LIBOR. Add the price fixing on gold and silver, which is not stated as such, but we know from our own research and from the conversation and chatter that CFTC does privately that is completely manipulated. So you end up with a situation where all prices are basically, in the imagination of those who are trading around that. It's virtual trading around phantom benchmarks.
Actually, Bart Chilton at the CFTC says they are going to investigate alleged price fixing at the London gold fix. Now, most of the mainstream media will say that is a conspiracy theory too far, that sure, they rig global interest rates, sure, they rig ISDAfix, a $367 trillion market, but good God, they would never manipulate gold.
Right. Well, of course, Bart, that's kind of his role, isn't it, to pretend as though he's a regulator of some sort.
Yeah, but it's also, I think, far more in this case, these markets and how these benchmark prices are set are so far beyond what most people understand when they go to the pump and pump up fill their tank. They don't understand that. So it's the role of the media, and the media is the one that's not reporting to people, that they couch it in wacky conspiracy terms that gold is somehow separate.
Well, speaking of the media, let me just point out the history of this. It goes back to Mr. Dow and Mr. Jones. When they created the Dow Jones Index, which became a benchmark, that was the first way to manipulate stock prices because they would leak ahead what components of the Dow Jones would be added or subtracted, same thing with the S&P 500. And that information became the basis of a huge insider trading scandals and trades over the years. I've been a part of it myself.
In this headline, EU oil manipulation probe shines light on Platts pricing window. We see this quote, the industry has developed a high degree of reliance, you can almost call it dependence on price reporting agencies, says John Driscoll, the managing director of JTD Energy Services. They have tremendous discretionary power in their ability to interpret and publish prices. So here you have it. He's saying that the price reporting agencies are interpreting prices for this global trillions of dollars of industry that affect real prices in the real world where people have to labor for real, go to a job, work the whole day like a schmuck, and then go fill up their gas tank at a price that some guys have interpreted. They've read the runes of the global financial system in both ways, runes R-U-N-E-S and R-U-I-N-S.
Right, so again, it's just a matter of looking, it's not price discovery. Prices are not, they're not the byproduct of buyers and sellers. What you see are people reacting to fixed prices that are set by insiders who are manipulating around those prices. Now we know it's in the energy business, as you just reported, LIBOR, or interest rates, gold and silver, credit default swaps. There's no market in the world that's not in some way tied to a benchmark whose value is simply stated from a subjective observation from somebody who's highly motivated to cheat. If I were long, 1,000 pounds of diamonds, I would say I think the price of diamonds is a lot higher than what it is today. I mean, that's what it comes down to.
Well, but it's also a form of sort of tyranny, because remember, part of the reason why we have Magna Carta and habeas corpus and things like this is because the kings would become very whimsical, and on a whim they would just behead all their friends because they decided on a whim that they didn't like these people. Well, this is very whimsical. It could be just because they need the price up or down by a fraction of a penny that day because they need to pay for their sushi, they're having lunch, they're sitting there with the bill is about to come. It's very whimsical, so it's a sort of tyranny over the markets.
It puts into context what happened in 2008 with Hank Paulson. Remember, he wanted to get through a $750 billion bailout for his buddies, Goldman Sachs on Wall Street. And they said, how'd you come up with that number? He said, it was just a one-page memo. He said, I looked at the market, and this is the number I came up with. I thought $1 trillion was too high. I came up with a $750 billion. Congress balked. So then they went there the next morning and they said, well, if Congress balks at this number, and this number that we simply made up, basically looking at what we could get away with, we're going to crash the market. Market crashed. Then they forced through that TARP relief program, and they all took home billions of dollars, and that's how it was done.
Well, the International Organization of Security Commissions concluded in October that price assessments could be vulnerable to manipulation because traders participate voluntarily, meaning they may selectively submit only trades that benefit their positions. So we know they do. And then I want to finally turn to this bit, because we're talking about these benchmark rates and illegality and the constant setting and fixing of prices in order to benefit fictitious trades that they've placed by using this fictitious trades and capital to remove wealth from the real economy. And now Jeffrey Sachs spoke in April at an event at the Philadelphia Fed on April 17th, and a lot of people have been talking about this because he talked about the criminality in the banking system. But there's one bit I want to talk about is where he refers to the bankers' bonuses.
And wherever you look, we see the same thing continuing till today, and that is massive, massive bonuses at the top of the financial markets, massive civil fines being paid for really incredible behavior, and massive campaign contributions going from this financial leadership to the political class. Yesterday's front page story of the New York Times gave 8 salaried figures. David Tepper, $2.2 billion paycheck. Ray Dalio, $1.7 billion. Stephen Cohen, $1.4 billion. By the way, half of these companies didn't even beat the market last year. It doesn't matter. They have a fee structure that is independent of any real performance.
Well, no, very few money managers or hedge funds beat the market. Not even Warren Buffett is beating the market at this point. I think 95% of all money managers fail to beat the market, but they create benchmarks. And when they go to clients, and these are typically very wealthy people who have either inherited the wealth or have monopoly positions in by gaming the government or gaming the copyright system or just outright thieving or copyright manipulation or a monopolist position in software, after a couple of $1 billion, you become kind of stupid. So you give a bank like JP Morgan your money, and they say, well, we created a benchmark. It's called the Jamie Dimon I'm a frickin' rip-off artist benchmark. And by that benchmark, we're beating the benchmark. We're not beating the market. We're doing lousy against everybody else out there, every asset class, including gold and silver. But according to the benchmark that we ourselves created, that we ourselves manipulate on a daily basis, that I base my bonus on, that I pay my billions of dollars on, we're doing great, so you should be happy. If you're not happy, what? I mean, more and more we're seeing instances of people, whether it's Aaron Swartz, who was murdered by the head of the MPAA, Chris Dodd, or others. If they don't like the system, they get whacked.
Indeed, they get whacked. And also, finally, that's what I'm saying, is that these are billions and billions of dollars being scalped from the markets, being paid on this bonus benchmark. There's a bonus benchmark, because now that's been established that 2.8 billion is the benchmark against which all these other hedge fund managers will now be judging themselves. So that's their benchmark that they have to meet. That's the contract that they have to close. So regardless of the performance, regardless if they beat the market, regardless of how they perform compared to their competitors, they will have to meet this bonus benchmark.
Right. That's why labor could set minimum wage at $100 an hour, and they can play the same game. All right, Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Stay tuned for the second half, a whole lot more. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Dr. Michael Hudson, author of Super Imperialism and his latest book, The Bubble and Beyond. Dr. Michael Hudson, welcome back to the Keiser Report.
Thank you very much, Max.
All right, the title of the book is The Bubble and Beyond. Are we now beyond?
Well, the legacy of the bubble is usually debt deflation. When the bubble bursts, prices for the real estate go down, prices for other assets go down, but the debts remain in place. So now we're in the negative equity stage of the bubble. We're in debt deflation, and people who have to use their money to pay back the banks and all the creditors whose money bid up all of the real estate prices. Now they have to keep paying, and there has been no write-down of debt to reflect the actual ability to pay. So you still have millions and millions of American homeowners that can't afford to pay. They're losing their homes. There are a lot of below-market sales that are all being bought up by large equity funds without any mortgage at all. The hedge funds have got into the business. So we're in the class warfare stage of the bubble. Who's going to pick up the pieces, and how can this be used as an opportunity to lock in low wages and to prevent wages really from rising again? That certainly in America is the neoliberal plan, and the Obama administration's policy is to keep all of the debts in place, to make sure that the banks don't lose money, even for false evictions. You've had millions of overcharging for rent, of fake mortgages. Nobody's being punished for this. People have lost their houses and are being paid, well, sorry, we took your house away when you didn't owe any mortgage. Here's $300 to compensate. It's a travesty of what's happening.
All right, let's talk about this term debt deflation for a second, because on one hand, the price of the debt is hitting 280-year highs in America. It's hitting 300-year highs in the UK, with the record low interest rates brought about by quantitative easing, the monetarism that's been the de facto global standard for conducting economic policies over the past 20 years. So when you say debt deflation, what are you referring to? Can I kind of drill down a little bit for us? Because debt is trading at an all-time high. But of course, when you talk about debt, you're talking about the price, also the yield. But can you just elaborate on this a little bit for us?
You put your finger on the point, Max. From 1980 through the present, interest rates have gone down steadily from their highs of over 20% in 1980 to just a 0.25% now for treasuries and for 3.5% for mortgages. When you have a lower interest rate, the lower the interest rate falls, the more you can borrow against a given income. So suppose you have a property that yields $1 million a year. $1 million a year won't carry very much of a debt at 20%. It'll carry only a $5 million debt. But once the debt falls to 5%, it'll carry it. This $1 million will carry a $20 million loan. So without increasing the interest charge, as the interest rate fell down, Americans were able, and Brits and other people, were able to borrow more and more money on a given real estate revenue. So people could say, well, look, your carrying charge has gone down. When the interest rate goes down, people bid against each other to try to buy property that's rising in price, and the winner is whoever is willing to pledge the whole rental income of a home or an office building to the banker. And so the banks ended up with all of the rental income being capitalized into a larger and larger debt. Well, the problem is, at some point, there has to be enough income to pay the interest charge. And people began to say, well, look, we're going to not only give you all of the rental income as interest, but we expect the price of the property to keep going up. So we're going to actually pay and speculate even more. And by 2007, 1/6 of the American real estate market was speculators. So all of a sudden, finally, when the prices stopped rising, speculators pulled out. There was a huge plunge of property values, and this plunge that should have been normally about 40%. It's already been about over 20% in many areas. This plunge of real estate prices left the debts in place. So all of a sudden, you had property in negative equity. You had the economy moving into a depression. You have more and more people spending all of their income to pay the bank. So now we're in debt deflation. Debt deflation is, in the United States, people, the blue-collar labor, now the government is guaranteeing real estate mortgages that absorb up to 43% of the buyer's income. So if you have 43% of your income going to pay the mortgage debt, you have about 15% of your income going to pay credit card debt and other bank debt. That's more than half your income going to pay debt. And then you have about 15% of your wages set aside for Social Security and wage withholding for taxes, and another 10% for other taxes. You have the American worker has to spend 3/4 of his budget just on meeting his monthly nut of wage and taxes before he has any money to spend on goods and services. Well, if you have only 25% of your income to spend on goods and services, that's why the economy is not recovering.
Oh, okay. So you tend to, your view of economics, if I can say, you're looking kind of through the prism of labor and wages, and what you see is that the wages are being gobbled up by increasingly on an increasing basis by interest cost, and this is causing essentially, I wanted to ask you something just because nobody makes the point that I want to ask you about this following question, because this is something that nobody really makes this juxtaposition, and I don't think really people understand how it works exactly, but the relationship between wages and interest rates. We know the relationship between wages, between asset prices and interest rates, because Ben Bernanke says we're going to drop interest rates to create a new housing bubble. We're going to drop interest rates to create a new bond bubble. But you're saying you drop interest rates, and you, at the same time, you're expanding the debt burden of the working class so that their overall interest costs at the end of the month are actually going higher, and they're getting poorer And so that's what you call debt deflation. But economically speaking, where do these two intersect? Interest rates and wages. Where historically and philosophically do they intersect, Dr. Michael Hudson?
Well, you know, when Ricardo and the classical economists sort of created value and price theory in the 19th century, the major element of the labor's budget was food. And so they would take the price of bread as and grain as a proxy for wage levels. But around 1900, you begin to have a democratization of property. And you begin to have, instead of a landowning aristocracy in Europe, people began to buy their own property. So now 2/3 of the population in America, England, Scandinavia, and most of Europe, 2/3 to 80% own their own property. But nobody has enough money to buy property for all cash. So they have to buy their homes, which absorb maybe 40%, 25 to 40% of their outlay. They buy their homes on credit, and that's where the interest rate comes in. So you could say that the interest charge and the debt charge, mainly to buy your homes, but now in America, they have to go deeply into debt to pay for their education. So if you're going to become a viable family in today's world, you have to go into maybe 40% of your income is to buy a home, which is what the neighborhood you live in determines your status. You have to take on education debt. And in America, student loan debt is over $1 trillion. That's more than all the credit card debt, more than the bank debt, and more than the auto debt put together. So after the home debt, you have the education debt, which you need as a kind of union card to get employment in today's world. And then you need other debt just to break even, because wages haven't gone up really since 1979. So the only way you can survive is on credit instead of on bread. It used to be, 200 years ago, when classical economics was developed, workers couldn't borrow. Only the rich could borrow. But now it's the whole working class and middle class have to borrow as a condition for surviving in today's world.
Right, and you still see some vestige of this in France, for example, where the state controls the price of bread. This is one of the fulcrums around which they manage their largely state-run economy. So let's just to recap a second. You're talking about student debt, you're talking about credit card debt, housing debt, and on top of this, we have to add health care debt, because Obama's new health care bill makes everyone have to go out and get into more debt to afford the insurance to have this new health care. So that's another new layer of debt. And all this debt is being managed by keeping interest rates artificially low, which are great for people who are speculating, driving stock market and housing to all-time highs. They have paper wealth. They're rich, quote unquote, but those low interest rates, instead of giving the middle class and lower classes some kind of benefit, all they're doing is simultaneously securitizing and monetizing ever bigger portions of what used to be run by the government is now run by private enterprise and financialization, which results in a huge debt burden, and you're calling this debt deflation. I want to switch over to Japan for a second, because here in this country, for the first time of any of these G20 countries, we're seeing something new. We're seeing interest rates in the 10-year bond go up, because confidence in the 10-year Japanese bond is going down. Interest rates have increased 100% in the last few weeks as they experiment with radical, over-the-top, multi-quadrillion yen quantitative easing. Can you give us some insight to what's happening in Japan, Dr. Michael Hudson?
Well, again, the key is interest rates. The way to explain that is what you've described for the middle class and the labor budget is true of companies too. When you have low interest rates like you have in the United States with quantitative easing, you have people borrowing to take over companies. And right now you have a huge increase in corporate debt, just like you've had in labor debt. And this corporate debt is not to invest in new equipment and build new factories and means of production. The debt is takeover debt. Companies are borrowing to buy their own stock or to pay dividends even. For instance, you have Apple computer here. that's borrowed at the same time that it's made a huge payment of dividends to its stockholders. You have debt leveraging to take over.
Dr. Hudson, if I can just cut in for a second there and focus on Apple for a second, because they outsourced all their jobs to China, so they're not in America. They have billions of dollars parked overseas that they're not going to pay tax on, but they're going to take advantage of these artificially low rates to create a $50 billion bond offering to buy back stock, pay dividends, to benefit the shareholders and the executives of the company. So the middle class gets nothing once again. Apple, it's really a travesty. But unfortunately, we're out of time, so we're going to have you on back again soon. The book is called The Bubble and Beyond. It's a follow-up to the classic Super Imperialism. Dr. Michael Hudson, thanks for being on the Keiser Report.
Thank you very much, Max.
And that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank our guest, Dr. Michael Hudson of michael-hudson.com. If you'd like to send us an email, please do so at keiserreport@rttv.ru. Until next time, Max Keiser saying bye, y'all.